Today I'd like to talk about taxes, and one segment of the tax issue in particular, the capital cost allowance and the undepreciated capital cost accounts. Taxes are probably the most difficult subject that's covered in this course, and so I'll be dealing with different parts of taxes in separate talks. So today, by concentrating simply on these two topics, I can make them fairly clear without rushing too quickly. Recall that for taxation reasons, there are advantages to using a declining balance method of depreciation. This is because declining balance recognizes that the asset decreases in value fairly quickly early in its life. By decreasing in value fairly quickly or in its life, that depreciation charge can be recognized as an expense, reducing a company's apparent profit, and thus reduces the tax it pays early. So companies want to use a declining balance method of depreciation. Now, since the declining balance method relies on a depreciation rate D, it would be desirable for a company to have as high a depreciation rate as it could, have one of 0.9 or 0.99, and depreciate the asset extremely quickly. That would be highly desirable from a company's point of view, but it wouldn't be desirable from governments or society's point of view, because then companies would avoid taxes in perhaps an extreme way. So the Tax Act limits the degree to which companies can depreciate, and they limit it according to what's called the capital cost allowance. What the capital cost allowance is simply a specified depreciation charge that can be used, a specified depreciation rate that can be used for calculating depreciation for tax purposes. Now, the particular capital cost allowance depends on the kind of asset that's being evaluated. For example, buildings don't depreciate very quickly. If you build a building, it'll last for very many years without losing value very quickly. So the depreciation rate is limited to 5 or 10%, depending on the kind of building. For general production machinery, 20% is the limit, and office equipment and computers. Automobiles, which depreciate more quickly, have a higher depreciation rate limit of 30%. So these capital cost allowances are exactly the same as the depreciation rate D by a different name. Now, what this means is that when keeping a company's books and calculating taxes for it, the different kinds of categories of asset have to be kept track of separately, so that the company knows by how much each of these assets can be depreciated, so that the depreciation charge can be calculated, so that taxes can be paid appropriately. But in fact, it's not necessary to keep track of each individual asset separately, just the ones that share a common capital cost allowance rate. So the assets that are similar in capital cost allowance are what's called pooled together into one account, an account being just keeping track of the numbers. This account is called the undepreciated capital cost account. So the undepreciated capital cost, if you like, is another name for book value. It keeps track of the pooled book values of the assets that share a common capital cost allowance. So for example, there'll be an undepreciated capital cost account for assets that have a capital cost allowance of 20%. A separate undepreciated capital cost account for the assets that have a capital cost allowance of 30%. And the amounts that are in those accounts are the total of the book values of all the assets that have contributed to it. So that's a brief introduction to these two ideas. The third point on my page here is a date, Friday the 13th of November, 1981. Also known as Black Friday. This is an important date, and I'll talk about that importance in a second. But first I want to review a little bit the ideas of of what I've said here. Companies have to depreciate their assets. They want to depreciate them quickly early in their life. They are limited by how quickly they can depreciate their assets by the capital cost allowance. The capital cost allowance is simply a specification by the government of the depreciation rate. The specification depends on which assets are being examined. Assets are pooled according to the capital cost allowance into an account called the undepreciated capital cost account. This keeps track of the book value of those assets so that the depreciation charge can be properly calculated. Now, talk about Friday the 13th for a second. If you buy something, or if a company buys something, from the moment it is purchased, it starts to depreciate. And it'll depreciate over the first year by a certain amount. But taxes are paid on a yearly basis. And companies don't necessarily follow the calendar year, but let's say a company is following a calendar year. So that before the 13th of November 1981, a company could in fact have bought an asset on December 31st of a year and counted a full year's depreciation on that asset, even though it only had it one day. Now, it would also be able to count a full year's depreciation on an asset if it bought it January the 1st, but the depreciation would apply for the next calendar year. So companies were taking advantage of this by delaying their purchases of assets till right near the end of the year. And the government felt that that was unfair. So it passed a ruling change that took effect on Friday the 13th of November 1981, which changed the rules a little bit and said that if a company bought an asset in a year, only half of that purchase price could be depreciated in the year the asset was bought. The other half could start being depreciated in the following year. That complicates things a lot. And we'll see the extent of that complication when we look at doing the tax calculation later. But for right now, the thing to remember is when you're determining that undepreciated capital cost allowance, that only half of the purchase price of the asset is added to that capital cost allowance the first year. The other half is added to the capital cost allowance the second year. Now I'll do an example to illustrate this. A company purchases asset X for $10,000 in 1991, asset Y for $20,000 in 1993, and asset Z for $5,000 in 1996. So we have three different things being purchased. Asset X is salvaged for $2,000 in 1997. We have a depreciation rate of 0.2, so this is probably production equipment. What is the undepreciated capital cost account at the beginning and end of years 1991 to 1998? Now we're going to be assuming here that the capital cost account is 0 to begin with. Now let's do this 1 year at a time. So the company purchased asset X for $10,000 in 1991. 1991 is after November 13th, 1981. So the new rules apply. New rules are that you only can start depreciating half the value of the asset in the year it was purchased. So that's why the UCC here is $5,000 at the beginning of 1991. Because whenever the asset's bought in 1991, for tax reasons or depreciation reasons, it's assumed to have bought at the beginning of the year, if you like, but only according to half its worth. So only half its worth depreciates over the year, depreciates at 20%, leaving a book value at the end of the year, book value for tax reasons, of $4,000. That's the UCC account. At the beginning of 1992, even though no new assets were bought in 1992, the second half of asset X is added into the UCC account. So it's the $4,000 at the end of the previous year plus the $5,000, which occurs at the beginning of 1992, making a total of $9,000 in that UCC account. which then depreciates at 20%, so that it totals $7,200 at the end of the year. Now, in 1993, we see that asset Y is purchased for $20,000. Again, only half of that purchase, under the new rules, applies to 1993. So at the beginning of the year, it's the $7,200 from the previous year plus $10,000, half the value of Y, which then depreciates to become $13,760 at the end of 1993. In 1994, the other half of asset Y comes in, adding to the $13,000 here for a total of $23,760, which depreciates down to $19,008. In 1995, there are no new purchases, and there are no second halves of assets to consider. So the beginning of 1995 is the same as the end of 1994, which then depreciates down to $15,000 odd. In 1996, as we can see from the question up here, asset Z is purchased for $5,000. That adds to the UCC by half that amount of $2,500 at the beginning of 1996. So we get $17,740, which depreciates by 20% to $14,000 odd. Now, 1997 is a little bit complicated here. Let me explain. First of all, we're going to get the second half of asset D, or sorry, excuse me, asset Z coming in. The second half of the $5,000 purchase price of asset Z, which is $2,500, adding to our UCC. However, note that asset X is salvaged in 1997. When something is salvaged, that means you're reducing your ability to depreciate that asset, and you have to subtract it from the UCC. So we're getting $2,500 put into the UCC plus $2,000 coming out. Now that $2,000 all comes out in 1 year, because this business of splitting the value of the asset over 2 years doesn't apply for salvaging, it only applies for purchase. So the full $2,000 comes out of the UCC, making a net change of $500. And that's what you see here, going from $14,165 to $14,665. That depreciates at 20% to $11,000 odd. There are no further changes in 1998 of $11,700, and that depreciates to $9,300. So keeping track of the UCC is perhaps a little bit complicated, but the principles are fairly straightforward. For assets you purchase, you increase the UCC by half the value of the year of the purchase, and the other half the subsequent year. For assets that are salvaged or sold, you decrease the UCC by their full amount in the year in which that sale or salvage takes place. Thank you.